Hi, my name is Jeffrey Aba-Onu. I'm a partner with the Capital Fund Law Group, and I'm giving a presentation on cryptocurrency and regulation of cryptocurrency funds. So, global blockchain technology could rise 11-fold by 2021, going from 2.3 billion today to 210 billion by then. And some people have analyzed that the current market value of all the cryptocurrencies out there right now is 98 billion. So it's a very, very, very high return market right now, which also means that it has a lot of high risk involved in it. And this is due to the fact that cryptocurrency is still a relatively new asset class. And what most people don't know, especially lay people and investors out there, is the mathematics behind cryptocurrency is very, very complex. Because of those two things, because it's new and has a lot of complex math in the background of it, it's very easy for scammers to defraud investors. So if you're looking to invest, the key is to try to find fund managers who have the knowledge base to navigate this complex world of cryptocurrency. So you want to look for fund managers who have a background or knowledge in cryptography, mathematics, and preferably coding. The first issue to go through is to answer the question, what is cryptocurrency? I have found that when I speak to lay people that they have a very hard time grasping the idea of cryptocurrency or virtual currency. So I would like to take you through a brief history of money in hopes that this will let you better understand the idea of cryptocurrency. So the first thing to know is, what is money? What is money? Money can be broken down into two things. It is both a medium of exchange and a store of value. So by medium of exchange, what that means is it's something that people in a community or society choose to accept. And as a store of value, it's something that retains its value over time. Now, there's some questions here about the store of value aspect. So take, for example, a currency that is going through hyperinflation. So if you look at Venezuela right now, they're having that issue, which is why if you go to Venezuela, most people will not accept the Venezuelan currency, the bolivar. They'll mostly take dollars or euros instead. And so you can argue that the bolivar is no longer money. But just keep that in mind, that money is both a medium of exchange and a store of value. All right. So if we go through the history of money, the first thing people will mention is a barter system. So a barter system is when people would exchange different goods or services with each other. Technically speaking, a barter system is a system of trade, but not money, because it's not really a medium of exchange. So for example, if person A wants an apple and person B has 3 bananas, they can trade 3 bananas for an apple. But then if that person with 3 bananas sees someone else with the same apple and wants to make a trade, that person might say, hey, I have all the bananas I want melons instead. So you don't really have a medium of exchange, but it's a form of trade. The first real type of money is what people refer to as commodity-based money. So commodity-based money is when you have an object that has intrinsic value, so value in of itself, and also serves as money as a medium of exchange. The earliest examples was actually salt. We forget now how useful salt was for civilizations back in the day. This is because before the days of refrigeration or even being able to produce ice in large quantities, people used salt to preserve food. So salt was actually a form of payment, of compensation. And if you look at the history of the word salary, it actually derives from salt. That's how useful it was. We also had other forms of commodity-based money. You had tea, you had shells. Some societies even had very large stones. But the most common forms of money were gold, silver, and copper. So if you go back in the days, most money, most coins were gold coins, silver coins, copper coins. And that eventually led to the gold standard of money, which I will talk about more later. After commodity-based money, you now have what's called fiat money, which is what we have nowadays. So fiat money is pretty much a currency that a government has declared to be legal tender. So they've declared that this currency will be accepted in their jurisdiction. But it is not backed by any physical commodity. So the currency is pretty much worthless. Hence the saying, not worth the paper it's printed on. It's completely worthless, but people use it because they trust the governments that have printed them. Now I'm going to take a step back because there was a huge leap of faith that went from the gold standard to fiat. I'm going to try and explain that very briefly, and then I'll tell you why this is very important. So, with the gold standard, which pretty much came around in the 1800s, money that was printed was backed up by gold. This was great because it gave stability, because there's always been a known reserve of gold out there. So you never really had inflation, and the value of money was stable. The bad thing about this, though, was if you had to make major expenditures, you couldn't, because there wasn't a way to produce more gold. And this always became an issue in times of war or times of massive construction. So the first time this became an issue was World War I. So World War I was a war between empires, not really countries. You had the British Empire, the French Empire, the Prussian Empire, which was Germany and Austria, and they had the Ottoman Empire and the Russian Empire. And in that time period, they chose to go off the gold standard, and that actually led to hyperinflation because they printed more money than there was demand for. So after World War I, they went back to the gold standard, and that lasted until the Great Depression. During the Great Depression, investors started to trade more in commodities and Forex because stocks crashed. And this put upward pressure on gold, which went up, which put pressure on governments to maintain the peg between their currency and gold. And so major governments were wary of the gold system, or gold standard at that point. And then everything came to a crash after World War II. Because after World War II, Europe was completely devastated, and so you had to go through a massive construction which needed more money than there was gold. So what the countries decided to do was to switch from what's called a gold standard to a US dollar standard. So the countries agreed in what was called Bretton Woods. They had a conference in New Hampshire in a place called Bretton Woods, and they decided that they're going to, instead of pegging their currencies to gold, they're going to peg it to the US dollar. And what would happen is if their currencies became too weak, they will buy back their currencies to reduce demand and increase the value of their currencies. And if they needed help buying back their currencies, they will borrow money from the IMF. So Bretton Woods also created the IMF. And if the currencies were too strong, they would just print more of their currencies to weaken it. And then in exchange, the US agreed to peg the US dollar to gold, but it was no longer a one-to-one peg. It now became $1 was worth 1/35 an ounce of gold. And then the benefits from these other countries was they also created the World Bank, which helped to reconstruct Europe. Now this worked for a while. There was still some issues with the US government because everybody wanted to have dollars, which put pressure on the US government to maintain that peg. But things came to a head in the 1960s during the Lyndon Johnson era because he went on some massive social spending in his war on poverty. Now I know if you follow politics since the 1990s, you've always had presidential candidates in the US from Bob Dole who always speak about the glory days in the 1950s and 60s when everybody had 2 houses, 5 cars, and their own jets. But if you actually go back in history, it wasn't that great for people. There was a lot of poverty, and Lyndon Johnson, to his credit, shone a light on that by going to Appalachia to show that some people were not living the lives that they deserve. And so he went on a massive spending spree, which put pressure on the US to maintain the peg. Then you had Nixon, and when Nixon came in, you had the Vietnam War. And that also put a lot of pressure on the US dollar. So what Nixon decided to do was to loosen that peg. So he went from 1/35 to 1/38 to 1/42, 1/42. And that created issues because investors now knew that the dollar was being weakened, and so they would trade in dollars for gold, which put more pressure on the dollar. And then the last thing, the nail that killed everything, was OPEC. OPEC decided to restrict the level of oil to punish America for some of our geopolitical actions in the Middle East. Due to that, America had what's called stagflation, which is stagnation, no growth, and inflation, increasing cost of prices, cost of goods. And because of that, Nixon just decided to end the peg altogether. At the time, people were very, very concerned about this. They did not think that the world currencies could float. But it did, and it worked perfectly. So the analogy I like to make is similar to Y2K. For those of us who grew up and went through the late 90s, before the year 2000, there was a big fear that computer systems would crash because computer codes maintained years with the last 2 digits. So instead of 1998, you had 98. And the fear was when you go up to 2000, 00, computers would think it's back to 1900 and you have a huge crash. That never happened. That's the same thing with what happened when the US went off the peg with the gold and let currencies float. Now, the reason I went through that whole story was just to make sure everybody understands that there was a great apprehension to have currencies that are not backed by any national assets or commodities. There was a great fear for that, but once that happened, it worked and everyone went through it. So, after fiat, which again is based on trust of a government, we now went to electronic money, e-money. So these are things like your credit cards. So if you think of it and ask yourself, how often do you buy things with cash, right? Or more importantly, how many times have you actually gone to your bank and said, show me my money, right? Nobody does that. We all rely on our bank statements and we take as gospel that the numbers we see on our computer screens, the 1 zeros, actually represents the money we have. So that was e-money. So again, you went from fiat, where you trust the government, to e-money, when you're trusting the banks and what you see on your computer screens, because you don't actually hold the money in your hands. So this has now led to the next evolution, which is cryptocurrency. Now let me take a step back. Now cryptocurrency has been referred to with so many different terms. There's cryptocurrency, there's virtual currency, there's alternative currency, there's digital currency, there's convertible virtual currency, but it's all the same thing. It's all the same thing. And virtual currency is very similar to e-money, meaning it only exists in the ether, only exists in your computer screens. It's only your zeros and ones. The big difference, though, is it is not backed by any central banks. It is not backed by anything. So people accept it as money because they choose to believe that in the future, other people will accept it as money. This is not the first time that we've had money that is not backed by a government. There is something called local currencies, which is where you have different communities that will come together and say, let's accept this monopoly money, let's call it J-notes, as money. And these things typically become more prevalent when you have huge financial crisis. So if you go back to the Great Depression, there was a whole bunch of local currencies around the country, but they did not last long, which is why some people are afraid that virtual currency might just be a craze or a fad that will go the same way as local currencies. But the best way to think of virtual currency is that it's like the money you have in the bank, which you never hold in your hand, which you never see, but you choose to trust it exists. But the big difference again is that the money in your bank is guaranteed by the government that runs or controls the bank, whereas with virtual currency, there is nothing guaranteeing the money. So that is virtual currency. Now, the next question would be, what are the benefits of having virtual currency? What are the benefits? The first thing to know about virtual currency, especially the way it's set up right now, is that it's decentralized, which means no one controls it. So it's decentralized. It's also, at this point in time, this is less true, but it also tends to be unregulated. And then also, typically, the money you hold is not held in your name. It's held in zeros and ones, a bunch of digits, so 1, 2, 3, 4, 5, 6, 7. So nobody knows who owns the money, so it offers privacy and freedom. So the first benefit for virtual money or cryptocurrency is fear of Big Brother. There are some people who do not want the government to know what they're spending their money on, right? There's just some people who like to spend cash, don't like to have bank accounts or credit cards because they're afraid that Big Brother can follow them. Then they're your criminals, right? That's what most people think with, cryptocurrency is used by a bunch of criminals, and there's some history to this. You had, the Silk Road, which was run by the Dread Pirate Roberts, who's my favorite character. So you had that went down, and then you also have hackers. So There was that hack recently, the WannaCry, where hackers will log into your system, steal your information, and only give it back to you if you pay them in Bitcoin. You also have people who want to launder money, right? So they can use cryptocurrency for that. They will take money that they've gotten through illegal means, switch it to switch it to virtual currency, and then switch that to real currency, fiat currency. And you also have people who try to avoid paying taxes, tax avoidance. Another reason why virtual currency has been very popular is in raising capital. Now, this one is based on the unregulated nature of virtual currency. Again, this is changing, and I'm going to talk about this later, but it used to be that you could raise money, virtual currencies, by doing ICOs, initial coin offerings, and you didn't have to follow the regulatory rules that were put in place by the SEC. So a lot of people like this because it's unregulated. So the way to think about it is America, back when we signed the Louisiana Purchase, and you had a bunch of people leaving the Northeast and going out west in search of their fortunes. And those guys could not really rely on any governments. There were no sheriffs. You just had yourself and your gun to take care of yourself. And that's what raising capital used to be. You just go out there, raise as much money as you want, make up whatever story you want. And so you had a huge surge in people doing that, and that's one of the benefits of virtual currency. Another benefit is that it serves as an alternative to fiat currency. So in times of financial crisis, people lose faith in their governments and choose to hold wealth in something other than those currencies. So you typically see a rise in gold, for example. And actually, it was in 2008 when Satoshi Nakamoto first came up with the idea of Bitcoins. Again, as a way, because in 2008 we had the financial recession. It was a way to hold money in something other than the US dollar. And another small reason is that there are some governments and people out there who hate the US and feel like the US is using its dominant financial position to bully them by placing sanctions and things like that. And so they can use another currency, hence Bitcoin.